Good morning, ladies and gentlemen. Welcome to this 2020 webinar, Tax Planning for the 5th of April 2012. I'm going to kick off by talking about that, certainly an old chestnut, should we pay a bonus or a dividend before the 5th of April? Should we delay till next year? If we are going to pay it this year, which is best, hopefully should be well known. I won't spend too long on that. We'll then move on to look at pension planning. We're just coming to the end of the first year of the new pension rules. We had some new pension rules in 2006, you may recall A-Day. We got another set of pension rules with this new £50,000 limit that we now have to grapple with, and there's some quite important planning actions that you might need to take into consideration before the 5th of April. One or two other topics I want to cover briefly. We'll have a look at the Enterprise Investment Scheme. Now I can talk for 3 hours on the Enterprise Investment Scheme, but I'll only bore you for 15 minutes on that today. The reason for mentioning that is, of course, this is the first year where the tax relief is 30% instead of the previous 20%. Some clients may be looking to shelter some of their income before the 5th of April this year. Alternatively, they may prefer to wait until the new CEIS comes in from 6th of April next year, which gives us a 50% income tax break and quite a generous capital gains tax relief as well. Right, this first session, then I'll keep this fairly brief because it should be fairly well known already, is the decision, should we pay a bonus or a dividend before the 6th of April? Now I'm assuming here that we're looking at the classic family company scenario where the directors and shareholders are invariably the same people, and therefore they're in that fortunate position to be able to manipulate how they take money out of the company. Here's an overview slide which summarizes the main methods of extracting profit from a family company, looking at certainly pensions advisor. I must say I've heard this rumor for the last 30 years, all the years I've worked in tax, but the odds seem to be quite short this year on the possibility of pension contributions being restricted to basic rate only, so no higher rate relief on pension contributions. The other rumour which is going around, again being spread by pensions advisors, is the possibility of the lump sum being taxed. Let's move on, before we take a quick comfort break, to liquidating the company and striking off. Remember earlier on I talked about the potential strategy of leaving value in the company with a view to taking that profit in capital form. If we don't need that money, that 10,000 in my other example, we leave it in the company, make it working capital to expand the business, and we do the same each year, we might actually not be able to sell the company, or we might decide to retire from business and either liquidate the company or strike it off. The key, I suppose, action point, not so much a 6th of April point, but a 1st of March point, is to, if we think we've still got time, start the proceedings, start the ball rolling and distribute from that company whilst the concession still applies. Let's move on to capital allowances. I briefly mentioned capital allowances there, particularly in respect of buying equipment for the furnished holiday letting business. We do have this tight deadline coming up where we have the significant reduction in the annual investment allowance and, of course, the significant reduction in the writing down allowance in the general pool and the special rate pool. Now, these, of course, we've known about for a year or more now. They were announced at the time of the emergency budget 18 months back. But obviously, we do need to keep reminding our clients of these changes. So the general pool, which for many, many years was 25%, currently 20%, goes down to just 18% from this April, which means I think somewhere around the region of 16 years to write off an asset down to 5% of its value. That's a very, very slow write-off. And the special rate pool goes down from 10% to just 8%. I'm told that will take 35 years to write off the asset at that very, very slow write-off rate. Remember, it's on a reduced and balanced basis. Let's move on. Now, I don't want to spend too long on this. I can, as I said at the beginning, I spent 3 hours on the Enterprise Investment Scheme. I just want to spend 10 minutes, maybe, just firstly reminding you of the current Enterprise Investment Scheme and then preparing you for the new Seed Enterprise Investment Scheme. Now, What we're looking at here is risky investments, and some clients I've spoken to about EIS said, no, that's not for me, I'm not prepared to lose that money. If you invest this year, we get 30% relief. If we wait for the new CDIS, EIS, we may be able to take advantage of the 50% tax break if we invest next tax year.